Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 3rd of February, the first trading day of February, the sort of morning after the night before when the trade war has begun. As was warned, has been delivered over the weekend. As we're all probably aware, the U.S. government announced tariffs on its three largest trading partners, its two closest neighbors, both Mexico and China, or Mexico and Canada, being charged with a 25% tariff, but largely energy exempt. If I read it all correctly, 10% on energy coming from Canada tariff rather than the 25%, and then 10% across the board on China. Once again, one would have to say the oil markets are shrugging it off like a sort of difficult meal over the weekend, but nothing dramatic. Up 1% this morning in Asian trade at 76.45. Let's kick off, as we do every Monday morning, with Omar Najia, Global Head of Derivatives at BB Energy, Head of Trading Derivatives at BB Energy. Omar, your thoughts of the news over the weekend. Should the oil markets be reacting greater to this event?
No, I think basically you've got to look at stuff incrementally. Nothing there's no system, either man-made or natural, that basically moves straight up in one direction then straight down in the other, right? So it's incremental steps. So the thing to see is basically this market, if you look at WTI, has moved from about $81 down to about 72. And basically, we've had lower highs, lower lows, lower highs, lower lows from the middle of January until now. Now we're basically seeing higher highs and higher lows. So I would suggest basically that downtrend is done and we're off to the races to the upside. The question is, how high does this move get us? There's a good chance that this move gets us back above $81 basis WTI. And we wait and see. But I think in general, this move is tariffs are inflationary. Tariffs are 10% tariffs on oil are basically make everything more expensive, from products that you make out of the oil to whatever I was saying earlier, like fertilizer, blah blah blah. So it's definitely inflationary, and it's going to push the price of everything higher. The question to see is what happens to the dollar, but I still think basically that the dollar is going to weaken. The US has a massive debt problem, and I think they're going to do two things, which is basically they're going to try and grow, which is very normal, out of this debt, but also they're going to try and inflate out of this debt. And I think Trump's going to do both at the same time. So I'd look for higher prices, at least in the medium term, immediate term.
Let's welcome Rosemary Griffin, OPEC Plus lead reporter at S&P Global Commodity Insights. Rosemary, I suppose the question here is, from an OPEC Plus point of view and from the world at large, does this move, this first domino, right? This is the first domino to go over, and actually doesn't go over until tomorrow. Will it disrupt world oil supplies? Will OPEC Plus be a winner or a loser in this? I mean, the Canadians export 4 million barrels a day of liquids into the US. Mexico, a little bit less than 1 million. Your thoughts on this event from a supply disruption point of view? You're on mute, Rosemary, and we do want to hear you.
Sorry, very rookie.
There you go.
I think that's a key question for OPEC Plus, really. They have a meeting today of the Joint Ministerial Monitoring Committee, which oversees their OPEC Plus production agreements. We're not expecting them to change their policy at the current moment. And just a reminder on that, the main thing we're tracking at the moment is the voluntary cuts. That's 2.2 million barrels a day of oil. They currently plan to ease those cuts from April. And I think the big thing for OPEC Plus at the moment, as well as OPEC itself, is what this will ultimately mean. So this is why I think you asked the perfect question for the moment. And we did have one senior OPEC delegate say to us a week or so ago that what they're really looking for is sustainable clarity. And that's sustainable clarity across the board. The other big issue, of course, that
Sure, aren't we all looking for that?
Yeah.
Sustainable clarity. I want that bumper sticker.
The other big question, of course, for OPEC Plus is sanctions, and tariffs have maybe dominated the news over the last week, but that's definitely still in the background. And I think it's not entirely clear which of the three main sanctions targets, Russia, Iran, Venezuela, will in the shortest term be really targeted. But one of the things we've seen since Russia invaded Ukraine in 2022 and became kind of the main target is that Iran and Venezuela, which are exempt from quotas under the OPEC Plus agreement, they've increased their output by almost 900,000 barrels a day. So obviously that's a sizable amount. And if we saw any kind of targeting of those barrels, then obviously that could drive prices up.
Anup Singh, Global Head of Shipping Research at Oil Brokerage. Anup, are we seeing any sort of signs in the brokerage, in the shipping world as to the impact of this now, the sanctions no longer, if they will happen, they're not sanctions, tariffs, if they will happen, they are happening. Obviously, they're coming now on the back of the sanctions that were introduced by Biden on his way out the door that targeted shipping. But are we seeing anything just in the last few days that might signal Canadians are looking for ships to move some of their oil now because concerned that they mightn't be able to move all of it in pipe through to the US? Any reaction on the shipping side? Your thoughts on this news?
Right. So yeah, we're starting to see reactions coming through both in the forward markets, which are the FFA markets, and more interestingly in tanker equities and tanker stocks, which tend to react in real time to these developments. What's come through so far is that the VL segment, the VLCC segment, is showing some level of softness and some level of stress. And I think that's explicable because there is a 10% tariff rolled into it on China as well. And China, as we know, is a big buyer of crude, and it buys a lot of its crude on VLCCs. Right? So there is the potentially detrimental impact on Chinese economy from these tariffs. I was looking at it the other day. China is a lot more dependent on the US as a trading partner, indirectly through Vietnam and Mexico now. So, and obviously it's becoming a much more export dependent economy, despite what the government wants to do. The share of exports to GDP is almost 21% in China. So there's a great level of uncertainty and potentially bearishness on the impact coming through from China and BLs on the smaller segments, which typically are involved in the North American crude trade, which are the Aframaxes, which tend to lift cargoes from East Coast of Canada and West Coast of Canada. There hasn't been too much of a reaction so far, but I would anticipate that unless there is a massive cutback in Canadian crude throughput, which at 10% tariffs, it looks a little bit unlikely, we would think that a lot of that crude from the East Coast and West Coast of Canada would start to go further away. And likewise, Mexican crude would also probably start to bypass or not go into the US at all and start to go into longer haul. Yeah? So it's moving targets, a puzzle which has to be still formed, but those are the early signs.
Omar, just picking up on the expectation of oil prices moving higher on the back of these developments, how does that sort of square with the idea that typically the tariffs on these scale, and we're yet the other thing that happened obviously over the weekend was the announcement that Trump re-emphasized that he would, Europe is next, basically. Generally the expectation is that this is bad for trade, bad for GDP growth, and so bad for energy demand, and ultimately bearish for oil prices. So what are your thoughts of that, of higher prices versus lower GDP?
Well, you got to basically take a bigger look, a bigger picture look, right? So, is the U.S. and Western economies, are they in trouble? Yes. Why? Because debt is massive. Because deficits are massive. Okay. So the question is, what do they do? So basically, what I think you're doing, which is again is not healthy, is you're seeing the U.S. Smack or put its hands or try to put its hands in the pockets of its allies because it can no longer do it to its enemies. So on that kind of level, yes, it's really bad and all this kind of stuff, undoubtedly. But the US is still by far, the biggest economy. It's going to get what it wants from its quote unquote allies, vassals, whatever way you want to look at them. But basically, for the US economy to keep going, it's a debt-based economy. They're going to have to keep borrowing and spending, which basically means adding liquidity to the market, which means basically more cutting of interest rates, more spending on whatever it is, defense, fixing the roads, whatever it is, or in the case of Trump, trying to bring manufacturing back to the US, right? And if you think about it like that, if you want to bring, manufacturing to the US, do you want to have a strong or weak dollar? You want to have a weak dollar. So what I propose is that what they are going to do is that they're going to do more spending. They're going to weaken the dollar. And by so doing, basically, they're going to run inflation hot. So basically, they run inflation hot and they reduce. The biggest problem the US economy has is their debt. So they want to reduce that debt. Now, the price of oil really to the US is, not, I mean, who cares really? But I think what they want to do is they want to try and balance and grow their economy and run inflation hot in order to reduce their debt burden, because that is absolutely massive. They have, I think I was looking at the graph, they have on their debt issuance, they have, I think, $10 trillion of debt, which comes due, I think, either 2025 or 2026, right? 10 trillion. So obviously they're not going to pay it back, right? They're going to roll it, right? In 2027, they have, I think, another 4 and another 2, and on and on we go. So that's the problem. So I think basically you're looking for inflation, but you want to keep that low enough so people don't start to scream, and you want to look for growth. So you want to look for basically price of everything goes up, right? So S&P goes up. Why? Not because of earnings or PE ratio or anything like that, simply because of inflation. The house goes up, not because of demand and all this kind of stuff and blah, 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 blah. No, because inflation's going up. There's more liquidity in the system. People have more disposable income. They spend more, price of everything goes up. Your iPhone,
so basically a lot more of what we've seen in recent years.
There's no alternative. Absolutely.
Rosemary, yeah, let me just move on to.
Sorry.
No, go ahead. Close out.
No,
Omar.
all I'm saying is basically the fact that basically the US has said that we are technologically superior, number one, iPhone 16, 17, 18, they all look the same. And now on the biggest thing on the face of the earth, AI, they get absolutely hammered by a Mickey Mouse outfit in China. So honestly, I'm just, my opinion is there's no other game in town than basically what's going to come down, which is QE, inflation.
So it's not drill,
blah,
baby,
blah, blah.
drill. It's print, baby, print.
Yeah.
Rosemary, the other thing that's happening today, if one takes the weekend's news, i.e. Trump following through with his campaign promise to tariff his closest neighbors and biggest trading partners, Mexico and Canada, one has to assume then he will similarly follow through with his other campaign promise to reimpose very strict sanctions on Iran, which has been enjoying a sort of a period of years of sort of loose enforcement of its sanctions, allowing a 1.5 to 2 million barrels of oil a day reach international markets. The Israeli Prime Minister is traveling to Washington today, getting, I suppose, alignment with Trump about his plans for the Middle East. Your thoughts on putting all of those things together and what the likely outcome from the geopolitical risks and sanctions enforcement for the oil markets going forward?
Iran is definitely one of the countries we're really looking at. They've pretty much maxed out their production capacity. They're adding, incremental amounts, 10,000 barrels a day here and there. We have heard from various analysts that it's unlikely to be as devastating as last time around in terms of barrels coming off the market. But even the latest sanctions, imposed by the Biden administration, they really hit Iranian shipping. So when you combine that with Russian shipping being hit at the same time, it's going to be interesting to see, is there going to be major logistical problems getting barrels to market on top of the new sanctions hitting production levels?
Anoop, the question really on this now is how everybody reacts, right? Trump's punches have been thrown. How will the counter punch feel? We've seen Canada announce 25% tariffs on $175 billion worth of exports from US to Canada. Your thoughts of where Asia might react, China's reaction, what that could look like, and what the impact for China might be. They sort of had a fairly muted response, one would have to say, over the weekend. Maybe they thought 10% wasn't such a big deal.
I obviously tend to put on a little bit of a freight hat freight turban when I look at these things, right?
Mm-hmm.
And to us, the fact that Canada has come back quite strongly in its retributory sanctions is just an indication that it's looking like it's a race to the bottom, at least in the short term, right? Canada is as you mentioned, is going after some imported US products. China hasn't played its cards as yet, but we suspect that China is going to be a bit of a wait and watch game, because its economy is a lot weaker, as I was saying earlier, than it was in the past. And at 10% tariff, it possibly could mitigate some of that by doing what Trump wants in terms of cracking down on the drug trade, but also by importing more American crude. Obviously, it is looking at potential losses in supplies from Russia, is looking at potential losses in crude supply from Iran as well. So, notwithstanding the fact that Chinese economy is slowing down, its crude demand is going down, it still needs that 8, 9, 10 million barrels per day of crude to be imported seaborne. Yeah. So the U.S. market would offer, it could offer something to the U.S. to sort of soften the blow from sanctions. So that's how we are looking at what tools would China have to play with.
How about Anoop, India? India might be harder hit by some of these, both Biden sanctions at the end of his term and now this start of this trade war. From its point of view of India having enjoyed a period of discounted oil imports from Russia over the course of the last 2 years, how do you see India's impact of these developments?
That's an interesting one, especially from the point of view of Russia, right? Because out of the 78 Aframaxes and 20 Suezmaxes which were sanctioned by the Biden regime, about 2/3 were active on the Russia to India trade. So yeah, India is bearing a large part of that impact. What does it really mean for Indian buyers? I think they would have to look for alternate crudes, and therefore one would anticipate that the era, at least in the short term, the era of cheap crude goes away. Yeah. Or rather, go is a strong word. I would say it's not as strong a discount that they might be able to get. Yet, the fact that 78, 80, 100, call it what you will, tankers have been sanctioned, does not necessarily mean that shadow fleet cannot grow again, right? Already we are seeing second-hand prices for the kind of tankers, the Aframaxes and the Suezmaxes, which are used on this trade, they've already skyrocketed. Right, a ship which was going for 30 million is now going for 42 or 43 million. Right, so there will be a concerted effort again to build back the shadow fleet. Net, the fleet needs about 50 more tankers to carry on with the same level of trade that it was carrying by the end of December, because there was a little bit of a fat in the shadow fleet as well. So you can run their fleet harder, and you can bring in additional vessels. It might be a period of 2, 3, 4. I don't know how much longer, but a finite amount of time before that fleet starts to become sizable again. So from India's standpoint, there's a period of pain, but potentially not for very long, the way we are looking at it.
I suppose that's the big question, isn't it? Is what was the word? Sustainable clarity, or what Rosemary said earlier. Let's go to the survey question and see where that is on this point. Do you expect Trump's tariff war to disrupt oil supplies? That is the question today. I should have maybe put in there global oil supplies, but oil supplies disrupted anywhere is a global event. But just, do you expect Trump's tariff war, as I would sort of frame this, the beginning of the tariff war? There's the first dominoes to go over. Europe is next, as was indicated by Trump over the weekend. China's part of this global. So that's the question. Trump seemed to step back from including oil and energy into that. Omar, I wanted to get your thoughts on, you mentioned in your earlier commentary about the impact for the dollar and other financial markets, but just starting with the countries can react to these things. One of their options, or only option, is manipulating or weakening their currency. The first reaction so far has been dollar strength. Euro now 102. I don't think I've seen it that low in a long time. Where do you see the currencies going, and the ability of countries to manipulate them?
So basically, if you want to escape tariffs, then what you need to do is weaken your currency against the US dollar. Because if they put 10% tariffs and basically your currency weakens 10%, then it has absolutely no effect, because you sell your goods, you make them in euros, you sell them in dollars, you convert back to euros, no tariffs. Same with China, right? So the question is, what happens? Why is right now the US dollar going up? And the US dollar is going up because of the usual flight to safe haven, right? So basically, there's going to be a trade war. Oh my God, sell risk, buy US dollars, sit and wait like a lemming and see what happens. But I don't think that's going to basically last very long. I think basically the US dollar is going to weaken. I think one very underreported, if not reported at all, fact is that when the US threatened Panama, they said that they would tax, confiscate, whatever, their US Treasury holdings, right? Which means that with the massive debt issuance that is to come from the Treasury as they keep, borrowing, who's going to buy it? And the answer is not very many, at least on the international scene, right? So, and again, Trump, one of the things that he wants to do is bring back manufacturing to the US, which is going to be very interesting. As a social experiment, let alone anything else. But if you want to do that, you need a weak dollar. You can't be manufacturing cars and the US dollar is worth goes up 10 or 20% because nobody's going to buy them, right? So I think in the natural progression for the US dollar is for it to get weaker. And the reason for that is because they're going to have to open the spigots, they're going to have to spend, and they're going to have to let inflation run hot. Because why? If you have $36 trillion of debt and your dollar's going up in value, then you're well and truly, smacked, right? If basically you have 36 trillion in debt and a burger costs 36 trillion, then you're really happy. So I don't think the path of the US dollar is going to be up for very long. I think it's going to turn a lot lower. And if you look at Trump in 2016, during his term then, what did the dollar do? It went a lot lower. So
well, it's certainly going to be, I suppose, for Europe at least, for Germany in particular, the biggest economy in Europe, this weaker euro continues to serve them some respite from a difficult economic equation. Rosemary, looking ahead for OPEC Plus, I mean, when we think about their sort of, obviously there's all of this noise in the world and they have yet to focus on their pathway, which ultimately is getting all of their 22 countries keeping them in alignment, keeping those countries that are not necessarily that are, if you want, not conforming with their output cuts. How is that looking? How is that alignment looking? It seemed at the end of last year was possibly under some stress. Looking forward, how do you see that and the challenge that OPEC Plus faces?
There's a couple of things that we're tracking. One is whether either OPEC or OPEC Plus as a group will coordinate some kind of response to Trump's policy, to tariffs, to all of this unpredictability, to the likelihood that we may see more price volatility over the next few months. And OPEC has always said that their target is market stability, so they don't like to give oil price targets. I think in terms of compliance, that's going to continue to be a really big topic this year. The main targets last year were Iraq, Kazakhstan, and Russia, although Russia has moved closer in line with compliance towards the end of 2024. Iraq recently, they have this outage at Rumaila, which is taking around 300,000 barrels a day off. So we may see them finding it a bit easier to meet compliance. But Kazakhstan has just expanded Tengiz. And last year, the months where they were close to compliance, they did that basically through maintenance. And they have a slight issue with these maintenance programs because these projects are being developed by IOCs. So they need buy-in from the IOCs to take these large number of barrels off the market, which obviously puts them in a slightly different position to some of the other OPEC Plus producers.
Anoop, I wanted to get finally to close out with your insights on other events over the weekend, which I think are quite significant. It was the U.S. Secretary of State going to Panama, and they're sort of the start of another sort of campaign promise to sort of challenge Panama and its management of this Panama Canal. Basically, it seems the main issue for the U.S. is the Chinese growing influence in that logistics management. 2 out of 5 terminals or something like that are being run by Chinese operators, and China has recently opened and managed a huge port in Peru. If you could talk to us a little bit, how serious is this? Your thoughts on what it could mean for international shipping?
Before the conversation started, I was joking with Rosemary that we thought we had got ahead of Trump's sanctions by saying that it's most likely bluster. Obviously, it is not. We've been proven wrong. So it's hard to be very categorical that that his approach to Panama is also anything could be real in nature. I think what's prompting it is
it's certainly real that China and China operators have got their foothold into Central America and Latin America.
Yeah, I mean, that's a huge trading partner for China, right? South America is a huge trading partner for China. A lot of Colombian, Ecuadorian crude goes into China. A lot of mineral trade is there. So it's an important trading partner. And Chinese companies, they are drilling for oil in the Gulf of Mexico, right? So
but on the logistics side, the port operating side, it's more than just lifting Colombian oil. It's actually managing and controlling the ports.
I suspect what's driving this enthusiasm for Panama is really what happened last year when there was this massive drought and the cost to transport goods across the Panama went up dramatically. And there's some merit to saying that, well, Panama could have managed it differently, by design, by investment, and so on and so forth. So I think that's where an economic argument could be made. But beyond that, it's probably in the realms of geopolitics, right? So that's where we look at Panama Canal. The one thing that I wanted to sort of bring on the table is
Please.
around the possibility of around the sort of thought process of tariffs and a relatively weak dollar helping a manufacturing boom in the US. We think so. We overall remain quite bearish as an impact of the sanctions on trade flows and freight, and even to the point that Trump wants to engineer a manufacturing boom. How would he do it in an environment where the inflation is running so high? Interest rates will not come down. Cost of capital will be so high. So you can tariff everything and say, well, I'm not going to buy your goods. My goods are going to be cheaper. But you can't incentivize industrialists to come and install capacity if they're going to pay 5-6% as cost of capital. So and I'm sure this is not lost on Trump, right? So the question is, well, how long does it stay on for?
That's also, we need to wrap up. The other part of that, of course, what do we have? Yes, do you expect Trump's tariffs nearly 50-50, but yes, winning out. We'll post on social to see the wider group thinks. But the other part of that point, Anoop, is the talent and the skill sets to do all of the things that you want to manufacture in the US. And I heard one interesting anecdote of that over the weekend, that most cowboy boots are now manufactured in China. Handmade cowboy boots, not just sort of like mass production cowboy boots, but actually hand stitched and all of that. And the skill set associated with hand stitching cowboy boots is quite specific and quite high level skill sets that just doesn't exist in Texas anymore. So getting Texans to stitch cowboy boots is probably a day past rather than a day future. And I don't think AI will help either. Anoop, thank you so much. Really appreciate it. Roseberry, great to have you on. Omar Najee, as always, quarterbacking Monday mornings. Thank you, guys. All the best. Oil up a little bit this morning, but no drama yet in reacting to the Trump move. Let's see what happens tomorrow when it actually happens. All the best. Have a great week, everybody.
Thank you.
You.